The Dow notching its fourth record close of 2019. 8 of the 11 S&P sectors were higher in yesterday's session, led by real estate, which was up 1.4%. Energy continued to lag the broader market. It's down 14% from its 52-week high. So is energy going to be a bright spot as we head into the winter months? And what names should you be looking at? Joining us right now for that is David Lebovitz. He's a global market strategist at J.P. Morgan Asset Management. Mike Santoli is here, CNBC Markets commentator. And our guest host, of course, Barry Knapp. Have you had a proper introduction like all hour? I feel like you might not have. I was actually just thinking about that from Ironside's Microeconomics. Thank you for...
Needs no introduction?
You need no introduction, so thank you for playing along. So the question I have, not just about energy, but just the markets broadly, just go markets broadly for a second, is you got China out there with the tariff situation.
Yep.
The question is what is baked in, what isn't baked in. The other thing I keep thinking about is as we head into December, everyone wants a sort of, Christmas Santa Claus rally situation. But there's part of me that thinks actually there are going to be a lot of funds that are actually just going to sell, lock in the gains that they have for the year and go on vacation.
So I think that's two separate questions. One on, do people take their gains into the end of the year? I think when you have a year like we've had, there's obviously a little bit of window dressing that goes on during the final month of December. In terms of where the market goes from here and what is in the price, I mean, I would agree with you. There's a lot baked in with respect to U.S.-China trade. I think that there's an expectation the tariffs on December 15th don't hit, that we begin to see material progress, perhaps even something in writing with respect to ag purchases and intellectual property protection. From where I sit, the market feels a little bit ahead of itself. If you look at earnings expectations for next year, consensus still looking for high single digits. We're more in the mid to low single digit camp. And the street is really banking on a rebound in margins, which personally, I think is going to be difficult to achieve if we're in this environment of trend-like growth, muted inflation, and continuing uncertainty. I mean, it's not like China's going to get resolved. And then on the other side, you have things like Brexit. You have the protests in Hong Kong. So stocks might be a little bit ahead of themselves, but clearly pricing in better economic data relative to what we've seen.
Let me say you on China, because we've been sort of debating what that even means this morning. If we get a deal, how much does the market actually move on that if it's already baked in?
I think the market is kind of rationally saying some kind of cosmetic deal will at least happen. And the way I view it is not that at that moment we're going to see a reacceleration of the global economy and it's going to be this investment boom. It might happen, but the market will give itself permission to look through what's going on right now and say, okay, we've got this inflection point. We got this out of the way. You go back to the first quarter of last year when the market was demonstrably cheap, but it seemed like that the economy was really in a bad place. And you had the government shutdown. And you had all these things that came along that sort of gave the economy a mulligan. And I think the market kind of feeds off of those environments right now. Yeah. You have bond yields quite low and unchallenging, both corporate and government debt, but not because we're bracing for an imminent recession. I think that's the formula for just the math works in favor of pay more for stocks, get more equity exposure. But the question to David's point is, do you have a market trading at 18 times forward earnings going into a year when growth isn't going to be that great? It's not as good a setup as coming into this year with 14 times earnings and you had a flat earnings
when you've
curve.
just seen a real downdraft in the markets. But Barry, that was kind of your point earlier this morning. The reason for why you would be buying stocks here, why you're long the U.S.
Yeah, no. Look, I think the market has rightly picked up on the bottom in earnings growth, the bottom in economic activity, the bottom in global trade and global manufacturing, right? So PMIs are starting to inflect the other way. Chinese ordinary imports, what they take out of the rest of the world, bottomed in July. It's moved from negative 7% to negative 2%, right? So you've already got this inflection higher, and that's what the market's reacting to. As far as trade goes, I think the way to think about this is, we started to talk about this a little earlier, is this stock and flow idea, right? So there's this existing stock of tariffs. The industrial sector's already adjusted to that. Margins came down hard from 2018. Now they're actually back up above where they were when the trade war started. So that adjustment's taken place. So now you have the business confidence channel. That's the flow of tariffs. If we miss the Dec 15th tariffs, business confidence will recover. It's not going to explode into 2019, sort of to your point, because it's an election year. There's all sorts of uncertainty, but it could move a lot, and you could see capital spending recover, U.S. manufacturing recover. That's good news probably through the first quarter. And then I think we really run into a whole bunch of election uncertainty and issues then.
The question is, right, how much does manufacturing recover? Because PMIs going from below 50 to just above 50 is very different than PMIs going from where they are today to where they were right
back to 60.
Election.
Yeah,
exactly.
yeah. And that's my point about business confidence and capital spending. It'll come back, but it's not going to where it was in 2018 in the aftermath of TCJA.
You think this election moment that slows things down is when?
It's past the first quarter.
Past the first quarter, but is that a second quarter, third quarter situation?
Yes.
And I think no matter how you kind of cut the mustard, right, we're looking at a year in 2020 where the consumer is going to be key. Because manufacturing, it can get better, but it's not going to be robust by any stretch of the imagination. And so you look at the labor market, mid-threes unemployment, wage growth kind of flat over the past couple of months. Does wage growth find a way to accelerate in an environment where labor supply continues to be taken up? And what does that mean for consumption? I mean, the survey data has gotten better here. Today we get personal spending and durable goods for the U.S. We need to see the improvement come through in the hard data. Right now you have volatility, very low, survey data improving, but it needs to come through in the hard numbers. Otherwise, I think this is going to be kind of a false dawn.